Hey everyone, Couch Investor here, back to another video for today. So in today's video, and it's probably going to be a longer video than usual because there is a lot to talk about. The battle between Disney, Bob Iger, and Nelson Peltz, activist investor. So he bought a stake in Disney, then went on, created a website called Restore the Magic, put up a whole presentation as to all the changes that he wants to see at Disney. Of course, he also wants a seat on the board. Then after that, Disney responded, in my eyes, a very childish response, but they do make some points that are valid, let's say. So we're going to go over all of that. Now, quick disclaimer, I'm no Disney shareholder anymore. If I were, I would probably use my shares to vote for Nelson Peltz, but that's just me. Now, another quick information before we start all of this. Bob Iger, CEO for 15 years, plus some extra background work as well. So work in the background, not background work. Then Bob Chapek came in. Obviously, COVID happened. Everything went wrong. Bob Chapek got fired a couple of months after the board backed him again. Got fired on a Sunday night, by the way. Bob Iger returns. Bob Iger has also a huge compensation plan, not just now, but before as well. Shareholder returns were abysmal, and that's why all of this started. Okay, good enough information. Now we can go and start. Of course, if you enjoy this type of videos, thumbs up and hit that subscribe button. I would really appreciate that. If you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So first slide I want to touch on is slide number 5 of the Restore the Magic presentation. Disney is trading at an 8-year low. Of course, the price right now is closer to $100, but the point here is the same. As you can see here, barely moved since 2015. Why is this important? Because as you will see in the Disney presentation, they will try and make a point that they did return a lot of value to shareholders, especially when Bob Iger was CEO. So keep that in mind. I'm not going to go over all of this. I just want to say that Trian has a pretty good past when they went in. Of course, the focus here is on what went wrong, and what went wrong was the Madison Square Garden type of investment. Didn't go to plan, but during an interview, first of all, he did laugh about it. Nelson Peltz did laugh about it. He did say that, well, the hockey team is doing good, but he did say that that investment was more of a personal one than a one like all of these companies right here. So there is that, probably a lame excuse, but at least he acknowledges that it wasn't a great investment. I'm skipping through a lot of things here, especially the Procter & Gamble case, etc. If you want, you can go and check it out yourself, but otherwise this video will be way too long. So I'm touching here on slide number 13. Disney's total shareholder return consistently underperforms. So 10 years, company proxy peers 478%, S&P 500 223%, Disney 107%, difference of 116% compared to the S&P 500. If you look at the 5 years, same thing here. Disney underperformed, actually down 10%. 3 years, it's down 34%. 1 year, it's down 39%. And of course, last year was its worst year on record. Then he goes on and basically goes on the attack on most of the board members. So Disney has underperformed under this board's watch. Remember this, under this board's watch, because the first page on Disney's response is, well, that this is the perfect board for Disney. Now, while Bob Iger just rejoined the board, he has essentially served on the board since 2000 with only a short respite from January to October 2022, around 10 months. As you can see here, again, they compare Disney's return to the S&P's return. All of them are in the red, which means they all underperformed. Then he talks about the strong case for change at Disney. So one, capital allocation. Of course, he was also talking about the M&As here. That's going to be a strong case for him. And then a rebuttal from Disney as well. Number 2, corporate governance, poor shareholder engagement. Yes, I want to touch on this again. I touched on this already in a couple of videos. I tweeted about this as well. And I even emailed Disney somehow through another department, because you as a shareholder, usually you can email the investors relations department. You can email them. With Disney, you cannot. There is no investors relations email. None. You can send them a letter if you want to. So if you're, I don't know, in some part of the world, if you want to contact Disney's investors relations department, you want to ask some questions about the financials, about the quarter, about some announcement, no email, just a letter. Maybe with a pigeon or something. Makes total sense, right? And then point number 3 here, corporate strategy and operation, flawed direct-to-consumer strategy. They talk about Disney Plus, how it compares with Netflix, etc. Why isn't Disney leveraging its IP more? It's a whole thing here. And of course, the big point that us, the consumer, are making is that parks are becoming way too expensive. So he says here, over-earning in the parks business to subsidize streaming losses. And he does make a point a bit later on, but first up, we have here the Disney's M&A and growth investment have been earning dilutive. So, yes, it's true that M&A has contributed to total revenue growth of 41% between fiscal year 2018 and 2022, but earnings per share has declined 50% over that same period. Now it goes on and touches on the Fox asset, the acquisition, again, way too expensive, didn't make sense, etc., etc. It's been a couple of slides like this actually, but we did talk about in another video that, well, most analysts or a lot of analysts are expecting that Disney will spin off ESPN in 2023. Let's see what happens with that. Now going back to the slide, this is slide number 25. He touches on the fact that for 57 straight years, Disney has paid a dividend and also a growing one. Since that acquisition of Fox 2019, you can see that dividend has been slashed. And then obviously when the pandemic started, there's no dividend anymore. A lot of funds, a lot of people have Disney shares because it used to pay a dividend and because they expect Disney to pay a dividend again. My prediction was 2024 when they think they will be profitable when it comes to Disney Plus. To be honest, right now, I don't really think that's going to happen. And here comes another blow to the Disney board, let's say, or decision making. The succession process is broken. Disney has failed to execute on succession planning, one of the most important responsibilities of a public company board. So, on November 20th, Disney announced that Bob Iger was rehired as CEO effective immediately, less than 3 years after he stepped down but remained executive chairman. Now, it is very funny indeed that the fact that Bob Chapek was abruptly fired 5 months after the board unanimously agreed to extend his contract by 3 years suggests the board lacks a robust CEO succession process and completely misread the state of Disney's and Bob Chapek's performance. As you can see here from this quote, June 28, 2022, Susan Arnold, the Walt Disney Company chair of the board. Disney was dealt a tough hand by the pandemic, yet with Bob at the helm, this was Bob Chapek, our businesses from parks to streaming not only weathered the storm but emerged in a position of strength. In this important time of growth and transformation, the board is committed to keeping Disney on the successful path it is on today. And Bob's leadership is key to achieving that goal. And here it comes. Bob Chapek is the right leader at the right time for the Walt Disney Company, and the board has full confidence in him and his leadership team. Well, that escalated quickly. And then he continues to talk about the succession plan that made no sense. As you can see here, Bob Iger transition timeline. So back in 2011 already, he signs an extension, a contract extension where he will remain chairman and CEO through 2015 and will serve as executive chairman through 2016. Then in 2013, signs an extension. 2014, another extension. 2017, another extension. Then another extension in 2017, which will see him remain chairman and CEO until 2021. February 2020, Disney names Bob Chapek CEO, Bob Iger to become executive chair through 2021 and will direct the company's creative endeavors. November 2022, the return of the king. Then he goes on and talk about the compensation plans here. So from fiscal year 2017 until fiscal year 2021, Bob Iger received $216 million in total compensation despite Disney's poor total shareholder return. As you can see here more in detail, if you want you can pause it and read everything in the fine print as well. But basically, compensation was extremely high when total shareholder returns were low. Of course, at the time, total shareholder returns were a bit higher than today, but you have to see the broad picture here. And then the last couple of slides, he talks about obviously the Disney, the streaming side of the business, how that is losing more and more money. He then goes on to compare it to Netflix, how Netflix is doing it a bit better than Disney, despite the fact that, well, Disney has all that intellectual property, etc., etc. Also, the fact that people say that Netflix does not have good shows, in my opinion, is just a lie. I think probably one of the most popular shows in the last 2 years were from Netflix. So there is that. And then the last thing I want to touch on with this presentation is what I said at the start. Disney is over-earning in domestic parks to subsidize streaming losses. As you can see here, before the COVID-19 pandemic, Disney's domestic parks had grown per capita guest spend at a 6% CAGR from 2011 to 2019, with more muted attendance growth. This has shifted dramatically, with management noting that per capita spending grew nearly 40% versus fiscal 2019 on its fiscal year 2022 earnings call. And then look at this right here on the right. For those listening, I'll just read it. Domestic parks percentage of Disney operating income. Fiscal year 2019, domestic parks 30%. Fiscal year 2022, 44%. Of course, in the short term, it's great that because the streaming side of things is not profitable yet, it's okay that the parks are over-earning, so it is, let's say, a short-term sustainable option, but it can hurt the brand in the long term if you're suddenly increasing prices like crazy, not really innovating the parks that much. First of all, you're alienating a large part of your fan base that cannot come to the parks anymore because, well, it just costs so much money. Second of all, even those that can come to the parks, they come, they pay once, and they see, well, the price has increased, but my experience is basically the same. What is going on here? So using the parks as a way to subsidize the streaming business, but not really innovate the park side of things, just doesn't make any sense, especially not in the long term. So I do agree with the points made here. Now, let's go and look at Disney's response, because they do make some good points, but the majority of it is laughable. So we start off with one thing I told you before. The current Disney board is the right board for shareholders. With the information that you saw before, well, this is very subjective. I'm going to touch on the most important points here. So first attack here, Nelson Peltz does not understand Disney's business and lacks the skills and experience to assist the board in delivering shareholder value in a rapidly shifting media ecosystem. Well, if you ask me, the presentation he just gave you was pretty valuable and made some good points. And here starts the, let's say, quote-unquote misinformation by Disney. So Bob Iger created significant value for Disney shareholders as CEO. So they gave him the time frame 2005 to 2020, huge outperformance, right? 554% versus S&P 500 of 244%. Now, of course, as we've just seen, Bob Iger did stay with Disney throughout the pandemic as well. And what happened there? Well, the stock price basically went back down quite a lot. So they're not really showing you the full picture. They're just showing you the most positive aspects here, which is something very funny because later on in the slide, they do include that pandemic period to show that, well, Disney got hurt by the pandemic. So either you're using the pandemic period to show all the returns, or you're not using it at all to make excuses for your underperformance. You can't have it both ways. Now, this is a slide I do agree with Disney. So first of all, these acquisitions here, Pixar, Marvel, Lucasfilm, great acquisition, made total sense. 21st Century Fox, I think 90% of people would say this made no sense, especially not for the price that they paid. Then, second of all, or third of all, I don't even remember, market capitalization. Okay, it has gone up because, of course, Disney as a brand has gone up in value as well. But market cap can go up as well when you're buying other companies. When you're buying other companies, that market cap can increase your market cap as well. And then it can obviously dilute shareholders as well. It talks here about share repurchasing and dividends. As you can see, they have repurchased shares throughout the years, paid dividends as well. Then fiscal year 2017 until now, well, share repurchase have basically disappeared, and so has dividend payouts. Now, talking about share repurchasing, which increases shareholder value, let's see how many shares outstanding there are. As you can see right here, it is true that share outstanding have been going down all the way until 2019. What happened there? The Fox acquisition. What happened then? Boom, a huge increase here of shares, basically taking us back all the way back to around 2012 or so, because since 2019 until today, shares have increased as well, because obviously they cannot repurchase more shares right now. So, well, shareholder value has basically been destroyed with just one acquisition. Now going back, they're trying to defend here the acquisition of Fox, so it was critical to position Disney better in the, well, let's say streaming game, etc. To me personally, I don't think it made any difference if The Simpsons, Family Guy was on Disney Plus. I subscribe to Disney Plus to watch The Mandalorian, to watch Marvel stuff and some other Star Wars stuff as well, not to watch The Simpsons. So, would Disney Plus have been a success without the Fox acquisition? Probably. Then they talk about the synergies and why it did make sense, etc., etc. They talk about, well, the fact that Peltz calls the balance sheet from hell. I do agree that maybe this is not really a balance sheet from hell, because we've seen worse balance sheets out there, but both here make a, let's say, solid point. But here it is. Point number 3 here. Global pandemic in fiscal year 20 and fiscal year 2021 dramatically impacted Disney, and as a result, we estimate that we lost billions in cash provided by operations. So, you see, now they do talk about this period that did not show in that chart, because if they did use this period in the chart, you can see that obviously Disney has underperformed the S&P 500, as Peltz has shown in his presentation. So they're really trying to play it on both sides here, which, let's be honest, doesn't make any sense. Then we go on and we have another attack on Peltz here. So he has no track record in large cap media or tech, no solutions to offer for the evolving media landscape. And if MSG Sport is his training ground, it has not been a good one. Okay, first of all, Peltz has no track record in large cap media or tech. So let me remind you what Bob Chapek did. Bob Chapek started at Disney in the home and entertainment side, then went on to be president of consumer products, and then, before he became CEO, he was parks and resorts. So, Bob Chapek, the choice of Disney, also did not have that track record in large cap media or tech. Yes, he had experience from Disney, but let's be honest here. And then to me, this is the worst thing of the presentation. Basically, again, Disney not showing the full picture. So, investment thesis, CNBC anchor, again, if you want, I can link it down below. I cannot show you this on screen. So the CNBC anchor asked, why Disney? To what Peltz answer, why not? And that's it. They're not adding any extra information. He went on and say why he thinks he should be going for Disney. First of all, it says we have skin in the game. It's one of the most popular IP brands in the world, most powerful one, adventurous one, etc., etc. So he did explain his investment thesis. He did explain the underperformance of the company in the last couple of years. He does not understand why they are spending so much, not earning enough, etc., etc. So he did explain the investment thesis, not just say why not. And then to finish it off, they did show us all the, let's say, communication between Nelson Peltz and Disney, whether it's a board member, Bob Iger, Bob Chapek, you name it. So they were in contact for a while. So to conclude, now that you have seen and heard both sides of the story, who do you think is, let's say, more right in this case? If you are a shareholder, who are you voting for? Are you voting with your shares for Nelson Peltz, for the activist, or are you staying with Disney's board? I know they appointed the Nike guy. Again, pretty strange that he's on the Nike board. He's the chairman there, I think. And now he's going to be the Disney one as well, both at the same time. Okay, but what do you think? Are you pro or against Nelson Peltz' activist vision? Let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And I'll see you all in the next one. Bye bye.